Awesome. Good evening, everyone. My name is Anam Omar. I'm a consultant gastroenterologist as well as co-founder and director of business relations here at Headway Capital. We welcome you all to our series of legacy building webinars. The topic of our webinar today is retirement strategies for healthcare professionals, diversifying with real estate. We're very excited and happy to see some familiar faces here, and we welcome all the new people who are joining, and we hope to see you for our future webinar series as well. Next slide, please. If you want these slides, please text us. Our number is 281-559-7061. This is our Headway Capital number, and you can get your slides from there. Next slide, please. So first and foremost, disclaimer. This webinar is for education purposes only and should not be considered as a legal or accounting or investment advice. The information in this webinar does not represent an offer to sell or solicitation of an offer to purchase an investment or securities. We advise everyone to consult their personal attorney, their financial advisor, their CPA for any legal matters, and in particularly any tax-specific questions, because that's very, very personal, your personal portfolio based. So those would be things that you would reach out to them for. Next slide. A little bit about Headway Capital. Now, Headway Capital was founded in 2017 by my husband, Sid Chamim, who is the founder and CEO, and myself, with the goal purpose of basically trying to preserve our own wealth, essentially, and building a legacy for ourselves. Prior to coming up with Headway Capital, we used to manage a lot of single-family real estate. We had a lot of single-family real estate at that time. And like a lot of you here, that was the first thing that a lot of us dive into. We actually had a pretty impressive portfolio of 230 houses that we were managing before 2017, but we were just not gaining the momentum that we'd envisioned for ourselves. So eventually, we just wanted to go big, think broader, wider, and we started Headway Capital, which has, of course, since then we've really accomplished a lot, and we'll go into our numbers shortly. We also have Brian Alfaro, who is the Director of Investor Relations. He's on this webinar today. He would be your key point of contact as well. And I would let Brian introduce himself.
I appreciate that. And nice to see everyone here. Welcome back to our Legacy webinar series. Really excited to present the topic today and to talk to all of our healthcare and non-healthcare professionals as well, but just won't take the mic for too long. My name is Brian Alfaro. I'm the Director of Investor Relations here at Headway Capital. And very similar to Sid and Anam, and maybe some of us in the audience here, I started investing in real estate by investing in residential houses. That was back in 2017, 2018 when I was getting started, and very quickly found out that it was way more work than I thought it was going to be, and I was making way less money than I thought I was going to be. So very quickly, we didn't want to trade time for money. That's what I was already doing in my corporate career. I started looking at alternative options to generate passive income, and then also to build my wealth at the time. I was in my late 20s, early 30s, and have a lot of time on the clock. Have a long way to go before I plan on retiring, but I wanted to continue to grow my net worth, grow my wealth, and also to build my cash flow. Started looking at commercial real estate in 2019, 2020, and transitioned over to multifamily commercial real estate in early 2020, right before COVID hit. Good timing, I guess you can say. And I was at a small boutique private equity firm for a few years, and then joined the Headway team earlier this year. And I'm excited to offer our investors great service, and I'm always happy to answer any questions. So feel free to reach out at any time, but I'll hand it back to you, Anam.
Thank you, Ryan. And we also have, of course, we have a great core team, and Umar Naqvi is our Chief Financial Investment Officer, also key point of contact. But we at Headway Capital, of course, our expertise is in sourcing, vetting, and investing in alternative investment opportunities. And we've grown remarkably since 2017. A little bit about our track record. We have about 239 million plus assets under management, which accounts for about a little bit over 3,300 units that we own and manage ourselves. Our targeted preferred return is about 7 to 10% per year, and of course, our annual average annual return after the final sale is estimated to be about 25 to 30%. What will a little just moving into our webinar now, what we're going to cover today would be retirement planning strategies, talk a little bit about cash flow, appreciation in real estate, and inflation hedge. Next slide, please. Where to start? So I think starting with your retirement planning journey would first start off with kind of figuring out how much would retirement cost, and how will you pay for it. So first and foremost, you have to figure out exactly what you think would be a safe number that you will feel safe and secure that, okay, I have this much, I'm okay with retiring. And of course, planning your future and having cash flow to maintain the lifestyle that you have envisioned for yourself, which may be more or less than what you're living right now, and moving towards it. So that would be the first point where you would start. Next slide, please. You also have to figure out your retirement goals. First and foremost, you do not want to run out of money before after you retire, of course, in your lifetime. So you have to figure out and make sure that you have enough income coming in, or you have enough funds for foreseen and unforeseen expenses. So you have to make sure that you have you don't run out of money. Most of us do want to maintain our current lifestyle, actually improve it. We're working very, very hard right now. We do want to eventually live an even better life, maybe travel, maybe spend more money on ourselves. So that is something that should be accounted for. Some people choose to spend every cent before they die, so that is another strategy. But however, other people choose to make a legacy for their future, for their children. So that's a different thought, a different mindset. Some people actually try to live frugally. They downsize after retirement, live a more simplistic, simple life. I don't know how many physicians choose to do that. I just feel most of us work very, very hard, invest a lot of time in our career, in our work. And I don't think that would be a choice that most of us would make. And of course, we do want to build wealth and legacy in future, and that would be what we should be aiming for. Options of how to do that. Next slide, please. How will you pay for your retirement? Some people choose to work. Hopefully, when it's time for retirement, that work should be a choice. A lot of people at that point should be working for fun rather than it should not be a necessity at that point. But some people choose to keep on working, so you may have salary that's coming in from your work. People have pension coming in and social security. Of course, that mostly is not enough to sustain your current lifestyle. People who have their own practice, a lot of times choose to sell their practice, make substantial amount of money, cash it out after selling their practice, downsizing their personal residence or other reinvested real estate investments that they have done and get cash out of that. But I think the key is for us to be able to predict your luxury spending versus your absolutely necessary spending to maintain which would be your lifestyle, which would be your car, your home, electricity, gas, food, and of course, very important would be healthcare costs and maybe college fund for your kids, so on, and kind of weighing that in as well. So you have to think about all these things when you think about retirement. Next slide, please. Now, traditional retirement strategies, I think most of us are already doing a lot of these. First and foremost, we should always max out on employer sponsored savings, which would be, of course, 401k. A lot of employers do provide matching to some extent. 403b. If you're self-employed, you can have your own 401k as well. And then 529 would be college fund for your kids. A lot of us have a portfolio in stocks. Of course, the amount of money that you keep in stocks varies from one person to another. It also depends on how much risk that you're willing to take. A lot of this, if somebody has a lot of money in stocks, it requires a lot of active management as well. A lot of sense and being savvy with when to buy, when to sell. And of course, the ability to take risk in case things go downhill. But, of course, this is a very volatile option. And you could potentially lose a lot of money there as well. But some people do make a lot of money in stocks. People go with a Roth IRA, which a lot of us may not qualify for Roth IRA, but there is a way to go through traditional IRA and convert it into Roth IRA, which is through backdoor IRA, of course, but that would be something that you would consult your financial advisor about. We do recommend everybody should max out on their HSA account as well. Of course, these are pre-tax dollars that you're saving. They grow, and you can use them for your healthcare needs. And of course, those are not taxed. So those are very, very good in tax saving opportunities right there. And then people have a mix of stocks, bonds. They may have small businesses that they may invest in. Some people choose to do trading, invest in art, but those are all options. But I think the thing to think about would be that, are these options enough? And of course, one other thought would be that most of the options that we're seeing here are volatile options. They are dependent on market stability. Inflation or recession in future may affect them. So those are things that we should all be thinking about. And of course, thinking about if the money that you will get out of them, would that money be enough? Next slide, please. Now shifting gears a little bit into real estate. There's a survey that was there, which states, and I just got it online, that 90% of millionaires invest in real estate to grow and protect their wealth and legacy, and which is true. Real estate provides a lot of different investment strategies, and it's a very stable way of basically preserving your wealth. One strategy would be that you buy a property, you hold it, you probably may be able to rent it out, get some rental income, and of course leave your property there. And with time, the property value will increase, and you get some money out of there. People could do active managing vacation rentals, or Airbnb as a way of investing into real estate. Of course, those are there's some tax advantages and right there if you are managing vacation homes or Airbnb. So those are short-term rentals are an effective investment opportunity in real estate. Flipping would be buying, renovating, and selling again. A lot of people could make money out of that. But these are mostly active options, which require us to be actively involved in managing them. And I think as a physician, most of us don't find the time to be actively involved unless we have partners or spouses or other infrastructure in place where we have that kind of help to that we are able to manage all of this. So a lot of physicians that I talk to do opt for passive investment opportunities, and that would be where real estate limited partnership would come in. And that would be a passive investment opportunity where you have an opportunity to be an owner in a deal, but there would be another general partner who would be managing it and kind of dealing with most of the headache that, or so as to say, involves with managing and this investment opportunity. But you do enjoy the passive income appreciation tax savings and all of that stuff. So that is, of course, an option that we provide, and we'll talk about that in a little. Next slide, please. Appreciation in real estate, of course, in addition to getting cash flow through real estate appreciates over time. There is supply and demand. People will always need homes to live in. I think the key is always figuring out the right property in the right location. You have to be very mindful about that, and that is something that we feel that we at Hedvig Capitals have a lot of experience in finding the right deals at the right location. You want to find something that is close to infrastructure. The infrastructure is growing there. People want to live there. It's close to their work. It's close to healthcare. It has good schools in that neighborhood, and of course, that real estate investment opportunity will appreciate over time. There's economic growth. Inflation makes the real estate value. Usually, it increases it, but real estate provides inflation hedge as well. We'll talk a little bit about it in the next slide. You can improve and renovate the property and increase the value of the property by improving and renovating it, essentially very similar to how you would flip a smaller property as well. With population growth, of course, more people need more space to live in, so your real estate does appreciate with time. And then with gentrification and development, the supply and demand, the cost of labor, the cost of building a new infrastructure, of course, is usually higher than an existing real estate property. So that really helps to increase the value of any existing real estate property as well. So appreciation is a key advantage that we see in real estate. Next slide, please. Real estate provides inflation hedge. With inflation, usually the value of the property increases. You're able to boost or increase rental income, which to match inflation as well. Real estate is a physical asset. It's not, just stocks or cryptocurrency, which you can't touch, feel. You will exactly be able to see what you're investing in, how that property is doing, make real-time changes to it if there's something that's not working out for you. And of course, it's an asset that's there that you can see, that you can feel, and most of us feel more secure with things that we have control over. If you have fixed rate mortgage, which would essentially be that you pay the same mortgage through the lifetime of the loan that you take, that provides a lot of protection against inflation as well. Replacement cost would again be replacement cost during inflation. Replacement would essentially mean that you build a new building, the labor and maintenance cost would be way higher. So it's definitely more cost effective to actually renovate an existing structure that's there, and your land value does increase with time. So all these advantages of real estate provide sort of help you beat inflation and help real estate being a safe investment opportunity. Next slide, please. So our final statement here would be, next slide, please. You would need to ask some questions for yourself. There will be some questions for you here. You should be thinking about exactly how much funds do I need to retire. We actually have a formula and a table that we could possibly share with you to just help you write down, your current expenditure, and to help you figure out how much funds would you feel comfortable with having when you retire. You should think about how you plan to get consistent cash flow, so that you're basically not running out of your funds during your lifetime. And you should think about if investing into real estate is the right strategy for you. And diversification is always preferred, and so that should be something that you should be thinking about if you're not already doing so. Next slide, please. Brian, would you like to take over discussing our opportunities
Yeah,
here.
yeah, absolutely. So, awesome presentation, and we're going to go into some Q&A and dive a little bit deeper. So please make sure you hang around. And if you have any questions, get ready to drop them in the Q&A box. But just to highlight a few options that we have here at Headway Capital, some opportunities that we present to our investors. As Anam and I have mentioned, we are multifamily specialists, as I like to say. Our majority of our portfolio is in multifamily or apartment complexes, so we provide opportunities there. We also have our real estate income fund. So if you're looking for an opportunity to diversify outside of the equities market, outside of the stock market, outside of CDs, outside of bonds, outside of treasuries, and you want to add a little bit of real estate to your portfolio, the real estate income fund is a great opportunity to get anywhere from a 6 to 8% return, depending on your investment, and it is liquid. So you can pull it out, your cash. You just got to give us a notice and you'll get your cash back in 90 days or less typically. So great option there. We also offer opportunities in car washes. We did one earlier this year. I see a few of our investors who invested in our car wash. So thanks for attending. And they've been very happy with their investment so far. That project's going really well. We started paying distributions on time and have been doing so since. Really excited about that portfolio. And then we do occasionally offer service business offerings as well. We do own a small construction company and a roofing company as well. That we like to acquire those assets so that we can improve the returns for our investors and keep costs down. So great opportunities to partner with us here at Headway. One thing I want to mention before we jump into Q&A, and there's quite a few questions in here, is if you aren't on our private investor list, if you're not a part of our private investor club, I would highly recommend you touch base with me afterwards or reach out to a member of our team. If you're interested in getting access to these offerings that we're talking about, by joining the club, you'll obviously get access to member-only in-person events. We do have an in-person event coming up here in Houston next Saturday, November 4th. It's a property tour where we're going to invite our investors out to actually visit one of our multifamily assets. If you would like to come to that event, you just need to have a quick conversation with me to get on the private investor club, and you'll be able to attend. We have a few seats left. We announced it yesterday. It's a small group that we're bringing. 20 to 25 is what we'll bring, and about half the seats are filled. So if you want to join that, please reach out to me. Shoot me an email after. So we do those property tours. We also have our educational webinars and events that we host in person, and then we provide those passive investment opportunities. You do have to submit an application. You do have to have a quick call with me or a member of our team, and you obviously have to be an accredited investor, which I have the definition there. So if you'd like to join the private investor club, scan this QR code. If you are looking at this presentation on your phone, you can't do that, just shoot me a message, and I'll make sure the link is also in the follow-up email that we get for the recording that comes out as well. And as I mentioned, we do have the income fund that is open for investment. So if you're looking for some passive income, it doesn't have any upside, but if you're looking for some cash flow, again, 6 to 8% cash flow on this. It does have a $25,000 minimum. Scan this QR code or shoot me a message. We'd be happy to talk to you more about that. A lot of our investors are very happy with this and have been in this for some time. So great opportunity to get some cash flow through real estate. So again, if you want these slides, just text us 281-559-7061. But let's open it up to Q&A, and you can shoot us an email here, investor@headwaycapital.us, or you can email me, Brian@headwaycapital.us. I got some questions coming in, Anam. So if you're ready, I'm going to start firing them off. Yeah. So the first one, this is a good one, and I'm sure you can speak to this one. Would you recommend paying off student loan debt before you start to save or invest for retirement?
So yes, I get that question a lot. I feel like paying off student loan debt is kind of a target for a lot of people. It's often something that we discuss during our endoscopy time as well. But I would say you should pay off your student loan with the cash flow that you get from your investments. So that's a different thought. You should invest your money, allow your money to appreciate over time, and whatever cash flow that you're getting from your investment should be something that you should use to pay off your student loan. I think something to realize is that your student loans are usually have a very low interest. And even though it is very, very stressful for someone to say that, okay, I have $300,000 in student loans, so on and so forth, but you have to understand that those student loans are usually have a very low interest sort of on them. And then you could have much higher cash flow or much higher return by investing that money rather into different investment opportunities. For instance, if you invest with us, you're getting an 8 to 10% preferred return per year, and you can surely use that money to pay off your student loans. So it's of course, it just depends on what you feel you're comfortable with, but that would be the right strategy.
Yeah, and I agree because these investments work really well due to compound interest. The longer you invest, the more money you make. So what ends up happening is, it might take you a really long time to pay off your student loans. I mean, I know people that are in their 40s and still have student loan debt, right? So if you're going to wait 10 plus years to start investing, where you're behind and you're going to be working much, much later, you're going to be working past 65 potentially, right? So I agree with you, Anam. I think it's better to invest today as soon as you have the cash available to invest, while also paying down your student loans at the same time. You can do both.
I mean, I also, you have to realize that when the final sale of a property happens, if you calculate, you're getting about 25 to 30% per year as a return after the final sale. So if you're doing a long-term investment and you are waiting for that final return, you're making much, much more money than you would. And it would really benefit you rather than using your money to pay off student loans. You should do that, but do it wisely.
Agreed. Another question, good healthcare question. Do you recommend healthcare professionals start by investing in single family homes first before transitioning to commercial?
Okay, so I that's what we did. And we have steered away from that. And I think, Brian, you yourself did that too. So, that is a lot of times that is the first thing that most people do, buy a single family home, invest, try to manage that, get rental incomes, give the property's value increases over time. I feel that most people do find it's the very safe sort of, they feel very comfortable doing that just because they feel that okay, we've bought our own house where we can do this, we can buy a rental property or something like that. But that is a strategy, but in my opinion, we moved away from that. We started investing into commercial real estate because it definitely makes you more money. Investing in commercial real estate, they're bigger properties, they have way higher returns, much less headache managing them. We had our properties flooded. There's always like some issue with some renters, some this and that. I mean, it was a lot of work trying to manage rental properties, and we were just not. It's your the time and effort that you put in and the money that you get out of it is just not worth it, in my opinion.
I would agree. I would agree with that. I think that's a big point. And I think sometimes too, I always encourage people like, look, if you want to really invest in single family homes and that's where you feel most comfortable starting, well, something is better than nothing, right? And it's a journey. So while we highly recommend you start with commercial, and we would love to partner with you in a passive capacity, if you just feel more comfortable being in the driver's seat and being in control, and you want to learn the hard way, as I like to say, kind of touch a hot stove and see what it feels like, that's okay too. There's nothing wrong. There's plenty of people that I know that have large single family portfolios and they like doing all that work. But to me, if you're a busy healthcare professional, you've got a family and you like to travel and you're doing all these things, I mean, it is really tough to manage. But I think the message I'm trying to say here is just get started, right? Don't wait. Do something, right? You have to do some sort of investing because the longer you wait, especially if you're just out of residency or you're still young in your career, you're just delaying, your ability to enjoy that compound interest.
I mean, I think an easier way to think about it is that if you have an apartment complex and there are a few apartments that are not occupied, it won't really matter much to you in the long run.
Right.
But if you have a rental property or a house that is your renter left, you're not able to find another one or another good one for another 2 or 3 months, then you've lost a lot of money right there. So I think that's just another way to look at it.
Yeah, there's definitely and this was an ask, we're kind of going a little deeper here, but there's definitely risk associated with both. And one of the downsides of a single family house is if there's no tenant, there's no money. That means that money is coming out of your pocket every month. And properties can sit on the market 30, 60 days, just depends. And you have no money, you have to front that mortgage. Well, in a commercial asset, we're buying 100 plus units. If we have 5, 10, 15 property units that are empty, of course, that's not the goal. But if we do happen to have that, well, we're still able to cover the mortgage with the income that we're bringing in from the other 85, 90 units, plus the other income we're bringing in from application fees, pet fees, different late fees, different things of that nature. So there's definitely some risk involved in both sides. But I think that's a great point to mention is to me, I think it's a little bit more risky to have one house and one tenant, but I agree with that. So what is the minimum investment to be a passive investor? Great question. So typically our investment offerings as low as 50, but I would say our average investor typically puts 100,000 in. It just depends on the project. Some of the smaller projects could be as low as 50,000, and then some of the larger projects could be 100,000, 75 to 100,000, but it's definitely for somebody who has the cash available. One thing that's really important to us is we like to build long-term relationships with our investors, and we don't ever want to take somebody's last 25, 50, 75, $100,000. So that's why we only work with accredited investors to make sure you have the capability, the capacity, and the risk tolerance to make that investment, because we're transparent with everybody. Like, look, these are investments. There's of course no guarantee, and there's of course in any investment you could lose your money. It's just like anything else, right? So we don't ever want to take somebody's last 50 or $100,000. So that's why we do have that minimum and why we do work with accredited investors. So great question. Anam, this is a good one for you too. Do you think there's a right or a wrong time to begin investing? I think they're kind of alluding to maybe like there's some, the market's a little shaky right now. Do you think there's a right or a wrong time?
I think the right time is to start investing now. If the market is shaky, the money that's sitting in your bank account is also exposed to inflation. It's not benefiting you in any way. I think you would serve better investing into real estate, or essentially any investment opportunity that's secure. But I don't know of a wrong time. I think it's always the right time to invest.
Yeah, that's a great answer. Here's the reality is there's always challenges in the market, right? So the last 18 months are a great example. So I'll paint the picture here. 2 years ago, everybody wanted to invest. Money was flowing freely. Raising money was super easy. People were calling us left and right. Brian, do you have any deals? I got money to invest, money to invest. And we were funding our deals in 24 hours. You can raise 10, 15, $20 million in a couple days, right? Crazy, just crazy. But what was the problem back then? It wasn't money. Its prices were really high, right? Everybody was trying to win these properties. So prices were really high. So you could argue that people were paying too much for some of these properties, right? Well, right now, let's flip the market. In 18 months since March of 2022, when the Fed started raising interest rates, the market did a 180. It literally flipped on its head. And right now, it's the complete opposite. Right now, people are very hesitant to invest. They don't think it's a great time to invest. And what happens to property values? They're down, right? So now we're seeing discounted properties available. Well, I don't know about you, but I like to buy things when they're on sale. So to me, it actually makes more sense now. But psychologically speaking, we're very influenced, whether we realize it or not, by one, what I call herd behavior. Everybody else is doing it, so I want to do it too. It's there's a term called FOMO, fear of missing out, right? So it's like when you see a stock and it starts rising, you jump on the stock because you think it's going to go to $100, and you realize like, oh crap, I got in too late, and now you lose a bunch of money, so you sell for a loss. That happens in real estate too, where people try to jump on the bandwagon and end up really realizing they're too late. Well, to me personally, I think the best time to invest is when you find a good deal, right? And a good deal is very subjective. People have different goals. But right now, people are very nervous. There's a lot of chatter, recession, interest rates. The Fed's coming out with all this data. You got job reports. It's the slowest residential real estate market since 1995. Actually, I think was the number. Last month had the lowest amount of mortgage applications since 1995. Just insane, right? Well, if you could buy a property at a 30% discount, knowing that in 5 years, in 10 years, it's going to be worth a lot more. Well, why wouldn't you want to invest in that project? That's how I feel about it. Now, it's a little nerve-wracking and scary, but to kind of summarize, I think now is still a great time to invest, but you got to find the right team. And that's what we're trying to, trying to build confidence here that Headway is the right team for you. And then you got to find the right deals, right? Which deal makes sense for you? Which deal aligns with your goals? If you find a great team and you find a great deal, what's going on in the market, as long as there's a solid business plan, it doesn't matter as much because these are long-term investments. We're going to sell these properties in 3 to 5 years. What's going on today will not be going on in 5 years. So it's important to think about the future.
Great.
Yeah. Last question I see in here before we wrap up. Please drop any more in. Actually, I got another one coming in. If you are, I got two more questions. If you're a passive investor, do you get to participate in the depreciation tax benefits? The answer to that is yes. Nam, any comments there?
I think it just really depends on your personal, I guess, portfolio or how you're working. It also depends on who you're married to, if they're working or not, or if they're able to like justify, because there is a way to get significant depreciation or enjoy depreciation from real estate investment opportunities, particularly if you are a preferred like real estate investor.
Real estate professional.
If
Yeah.
if you have the real estate professional license, and you can only get that if you're, at least like putting in, I think it's 15 hours per week in real estate, right? Like actively managing real estate. So if that's that, then you can get significant tax benefits by investing into real estate. But it really depends on, I mean, that this would be a question. I think we usually try to avoid advising people about it because it's just so variable between different groups of people that this would be something that you would reach out to your own CPA to discuss with them. And of course, I do though advise everyone to get a CPA who has experience with real estate, because I find that to be a common problem, that people do get really, really good CPAs, but those CPAs do not have experience with saving tax, saving tax by investing into real estate. And even if you have invested into real estate, they don't account for that when they're filing your taxes. So you should definitely get a CPA that has experience with that.
That's a great point, and I actually hear that all the time. Not every CPA understands real estate, and it's really important that you have a CPA that understands real estate, that works with other healthcare professionals that have high incomes, that understand real estate. And to Nam's point, the only way you can really enjoy all the full benefits of real estate is somebody, if you're, let's just say you're married, somebody, one of the spouses has to be a qualified real estate professional. QREP is what the accountants like to call it. And it basically means you have to meet some qualifications to qualify in order to join, to basically have your real estate depreciation offset your, say, your healthcare income. It's not common. Somebody on your spouse, on your family, either the husband or the wife, that one of the partners has to be basically full-time real estate and be able to prove that they're full-time real estate. So, if you're a healthcare professional and your spouse is unemployed or not working, it's always a conversation to consider. Of course, talk to your tax professionals and your attorneys if they want to get into real estate and they're excited about real estate. Well, if they get into real estate full-time, there's some additional benefits your family can enjoy overall for the income you bring in. But if you're not, there's still, the income that you get as a passive investor will be tax deferred based on the K1s and the depreciation you get on an annual basis. So the income you get from your passive investments, they're going to have depreciation count against them. So it's usually going to show some sort of loss on your passive income, not your active, healthcare income, but your passive income. So the way it qualifies is, again, I'm not an accountant, speak to your professional, but there's an active income bucket and there's a passive income bucket. All your passive income cash, that bucket right there, the depreciation you get from investing with us will count on that bucket only. It will not count on the active bucket. Now, if you're a real estate professional, the depreciation counts for both buckets, which is a beautiful thing. But it's not very common. And I always recommend you talk to your your accountant, your CPA, before you make any type of decisions or investment, just to make sure you have the right strategy that's going to meet your goals long term. So those are all the questions that we have coming in. We did have a question coming in about are our investments leveraged or are they cash only? I did send a message about that. We do lose leverage in our investments to improve our investors' returns. They're not bought all cash just because these investments are typically $20, $30 million plus. So they are bought with leverage to maximize our IRRs and our overall returns. But good question. Anam, any final words before we sign off?
No, I think, whoever is interested, please text or scan this QR code, reach out to us. We're here to answer any questions. Of course, we do these webinars. I do them every 2 weeks. So if you have any questions, join in for our next webinar and we can discuss those then as well.
Awesome. Thanks everyone for attending. We will see you on the next series. Have a great day.
Thank you.